So let's get started. My name is Leslie Miller. I'm a recently retired agricultural lender here in Knoxville, Iowa. I worked for Marion County Bank, which is a bank that works throughout Marion County. I've spent 42 years in the ag lending industry, so hopefully I can share some of my experience that I had as a banker with you today so you can understand what bankers are looking for when you're applying for a loan and maybe give you some tips that will help you get some better loan terms, as well as maybe work with your lender to set up more or a better repayment program for you. So one of the things I'm going to cover is just kind of give you a background on the different types of lenders that are out there today and what types of loans they offer. But I'm also going to dig a little deeper and talk about the ratios that are used by lenders, because many lenders will do analysis using financial ratios to decide whether they're going to make a loan or not. And I think it helps you to know what some of those ratios are. We're going to do a financial statement review, just kind of talk about the balance sheet. Ryan Drollette's going to go in and show you how to prepare one in Ag Decision Maker and kind of walk through some of the cash flow aspects of Ag Decision Maker. And then we'll come back and talk about your cash flow and how we use some ratios from there to further analyze our loan process and give you some Iowa farm benchmarks that might, again, help you as you go in and talk with your lenders this winter. And then just some final thoughts to summarize, what we've talked about today, and hopefully allow some time for questions if there are some. So the types of lenders, if you look at the first four on the screen, they're the ones that people are most familiar with, community banks and commercial banks. The community bank is pretty much that local town square bank that you have on your town square. It's usually a local board of directors. They're people that oftentimes know you very well, know the community very well, and they're easier to work with because they are locally located. On the other hand, the large commercial banks, the Bank of America, Wells Fargo, Citibank, those are banks that are not locally located. Their board of directors is far away. And so some of their concerns or some of their terms and processes are a lot more complex than it would be with a community bank. They are out there doing loans to agriculture because community banks are limited on the amount of money that they can loan to any one individual operation. And because of that, some of the very large operations have to work with those larger commercial banks. Farm credit system, I'm sure you're all familiar with that. They were started in the 30s specifically to make loans to farmers. Most of the farmers that they work with today are very large farmers. They do have a few loans out, interestingly enough, to Verizon, the cell phone company, and a few other entities that really don't seem very much agriculturally related, but they have been able to do that to expand their loan base. But they're primarily there to serve farmers and rural homeowners, and they are a good source of credit for farmers. The Farm Service Agency, I guess I recommend them to a lot of beginning farmers because they do have much lower interest rates. They have better repayment terms. They'll a lot of times stretch payments out a little bit longer to make them easier for beginning farmers. But they're also a good source for farmers that might be struggling with their current lenders. If they need to refinance a loan and work at better loan terms, that's the place where borrowers can go to get those better terms. The last three on the list, the IADD is actually the Iowa Ag Development Division. They are responsible for the beginning farmer loans in Iowa. If you're a beginning farmer and you want to purchase real estate or other depreciable type assets, you can use that program in conjunction with your local bank to get your interest rate down. The insurance companies, again, we have insurance companies in Iowa that do offer real estate loans. They don't really do anything other than real estate loans, and they can offer some decent terms. And the credit unions and the fintech lenders, credit unions are more recently coming into the ag lending category, so they might not have quite the ag expertise that some of these other entities have. And the fintech lenders, those are the lenders that you find on the internet. Some of them have some very good terms, but I caution people if you're dealing with them to make sure you read the fine print. I've seen some instances where they might have 0% interest on inputs, and then you get to September 1st, and if you haven't paid that bill, all of a sudden you have 19% interest that's retroactive from the time you borrowed the money. So make sure you read the fine print on those fintech programs. As far as lending products, again, going back to those first four on that list, they're pretty much all the same. Operating loans, livestock loans, machinery equipment loans. And as far as real estate loans are concerned, all of the lenders except for the Farm Service Agency can refinance real estate. Farm Service Agency can only help you purchase real estate. They cannot refinance real estate loans. So you want to keep that in mind as you're dealing with those lenders. And beginning farmer loans, again, all of those entities will work with beginning farmers. Commercial banks are the ones that give you the best benefit or interest rate reduction in working with the beginning farmer loan program. But FSA, the Farm Service Agency, has some really good terms for beginning farmers that I think are important and will help you pay for real estate. So with that in mind, do those lenders look for different things? No, they pretty much look for the same type of information. They want to make sure you have a good financial statement, a really strong financial base. They really want to make sure that you can repay the loan. I mean, that's the most important thing. If they loan you money, they want to make sure you can pay it back. They also want to make sure that you have some good management practices. Are you taking care of your cows? Are you mindful of your crops? Are you looking at extension information to get some of the latest practices and techniques? Those are important. We also want to make sure as a lender that you are managing the production risk, maybe by buying crop insurance, and managing the market risk by forward contracting or putting in place a marketing plan that might help you secure better prices. And last but not least, we talk about leverage as lenders. Leverage is just a fancy term for debt. And we want to make sure that the people we loan money to respect the fact that the more debt you have, the more financial risk you have, and don't just go out and borrow money as much as they can. They want to respect that debt load. And if you come in and you're talking to us about a loan to expand your operation, we got to make sure you have that capacity to grow. If you're talking about cash renting additional acres, do you have the machinery to handle it? If you're talking about buying more cows, do you have pasture and hay ground that will handle those extra cows? That's very important in determining whether you get the loan or not. So with that in mind, when you're applying for a loan, what do you need to bring? What do you need to do? I tell you, everybody talks about written business plans. I will tell you, in my 42 years of ag lending, I bet I've seen 3 written business plans. Usually what happens is someone comes into my office and they sit down and they say, I want to borrow some money to buy cows, or I want to borrow money to buy a tractor. And basically pull out the yellow notepad and we start making notes. And that's how that's how they tell me their business plan. I ask them to tell me about their operation if I don't already know about it. Just kind of what their plans are for the future, what they're actually buying. I also look for a balance sheet or a financial statement so that I can see what they have. They've got a strong financial base, but also what they might have for collateral that I can use. If they don't have a cash down payment, it might be that they want to borrow all the money that it takes to buy that tractor, but I can look at that financial statement and see that they have other machinery that I could use instead of a cash down payment to help secure that loan. So that's important for me to see and to know. And then last but not least, I want to see a cash flow. And if they haven't put a cash flow together, we'll sit down and put one together to determine how they can repay the loan and if they can repay the loan.
So in your opinion, then, is it better to have that conversation rather than to have that personal conversation rather than to bring in like a written business plan? Does that maybe create more rapport, or kind of?
I think it's perfectly fine. I think it's perfectly fine to bring in a written business plan. Some people, that's how they think. That's how they flesh out their thought process or find holes in their plans. And I think that's perfectly fine. But if you don't want to go to that extra time and effort, I don't think you have to. Just have some points lined out in your mind or on a sheet of paper in terms of what you want to tell that lender about your operation, what some of your strengths are, and what you want to borrow, how you're planning on repaying the loan. That's perfectly fine as well. You don't have to have it written down. So it's just the personal preference of the borrower. If you're more comfortable having something written, fine. If not, don't be afraid to come in and just have that conversation.
Sure.
So
thank you.
And and all that information is great. Some lenders need more than just that, but all of us will sit down once we gather that information and we do an analysis on whether we want to make the loan or not. Some banks, they have to send that information off to a central approval point. I was lucky enough to be in a bank where we were responsible for doing our own analysis, and we approved the loan right on the spot, or within 24 hours, because we were doing the analysis. With that in mind, I have 5 ratios that I have consistently used, and I think they're ones that are pretty much used throughout the lending industry. But the reason for these 5 different ratios are there are 5 areas that we look at when we're looking at a farm financial statement and an operation's ability to repay. We look at their liquidity. Will they have enough money on hand to pay debts as they come due? We look at their solvency. Are they going to, if something happened where they had to stop their operation, are they going to have enough money to pay the debts that are out there? We also look at profitability, because if they're not going to be profitable, they may not exist 5 years down the road. We want an operation that is making money. And then I look at one that's what we call a financial efficiency ratio. It's the operating expense to revenues ratio. And that ratio actually tells me how easily a farm operation can handle setbacks like lower yields or lower prices. And we'll talk more about that later. And then the most important ratio that every lender looks at is repayment capacity. We want to make sure that you have the ability to repay the loans that we make to you. Again, I talked about the financial statement. We pretty much generally ask for that. We also, as lenders, will ask for like past tax returns or past income statements if you've prepared them. The reason for that is that kind of gives us a base for what your operation has done in the past. The thing that I always caution, I teach bankers at the Ag Banker School every year, and I caution them about looking at those tax returns, because those are usually prepared on a cash basis. It can be very misleading. It's nice to have them, but by the same token, they got to keep in mind that debt is repaid with future income, not what's happened in the past. And so what I usually use tax returns for are to look at maybe what the operation paid for property taxes, or what they paid for utilities, repairs, things like that, that don't fluctuate a lot from year to year. But I will plug in, current values for operating expenses like, seed corn or fertilizer or whatever, because that you get a more accurate sense of what's going to happen in the future year. It's also helpful to me. It's helpful to other lenders to get an idea of what historical yields are. So they might ask you to bring in something that shows like what your APH is or what your yields have been in past years, so that they're using a realistic figure on that cash flow. Input costs, rental, if you're cash renting property, we might want to know what the terms are on that. Do you pay all the cash rent up front? Do you pay it half and half? Those kinds of things. Is it a flexible lease? But all that information is used to do a projected cash flow. And then last but not least, we might ask for proof that you do have crop insurance, because that is a little bit of a risk management program. Other lenders, they might get much more strict in their requirements. They might want to see, copies of your liability insurance or life insurance. They might want to see detailed marketing plans, those things. But most community banks don't really get that restrictive. So talked about a balance sheet. Assets on the balance sheet are not where you park your rear end. They are the items that you own or you're in the process of owning, like livestock, grain, machinery, real estate. You don't have to have them paid for, but it's assets are things that you own or will be owning. Liabilities, which also go on the balance sheet, are any debts that you owe. If you've got any fertilizer bills out there or feed bills, property taxes, income taxes, cash rent that's due. You might have machinery and real estate loans or livestock loans. Those are on the liability side of the balance sheet. And then what bankers will do is take the assets, subtract the liabilities, and come up with net worth. Net worth is the difference in those two factors. And that's really what the banker looks at in terms of how strong is this operation? What's its financial base? So just to give you an idea, a little more specific idea, some of the assets, the types of assets, usually what a financial statement does is divide your assets into 3 categories, and your liabilities as well. There's current, intermediate, and long-term. Current assets are things that will be converted. If they're not already cash, they'll be converted to cash within the next year. So you might have money in a checking account. You might have money in a savings account. You might have a hedging account that has money in it. Any of that stuff that can be converted to cash, like grain or calves. You might have accounts receivable or government payments. Those are all current assets. Intermediate assets are breeding livestock like cows, sows, ewes, that breeding livestock and machinery and vehicles are all something that we call intermediate assets because they will wear out within a 7 to 10 year time period. So we don't want to put them as a current asset because you really don't want to sell them to keep your operation going. That's kind of the base of your operation. They're intermediate assets. And then the long-term assets are things that you really don't want to sell anytime soon. They're long-lasting, like land or a retirement account that you're not going to be accessing anytime soon. But it's something that's in your operation long-term and does usually not depreciate. Again, as I said, the liabilities are divided into 3 categories as well. You have current liabilities that are things that you have to pay within the next year, like operating loans, any accounts payable that you owe, income and property taxes, your and credit card bills, some of those things. All of those things you're going to try to be paying within the next year. So they're current liabilities. Intermediate liabilities are your breeding livestock loans, your machinery and car loans. One of the things we do with intermediate loans and with long-term loans is we show what that debt is, but any part of that debt that's due, like interest and this next year's payment, they actually get pulled into the current liability section. I'll show you that when we look at this financial statement in a few minutes. And of course, the long-term liabilities are your real estate loans. So I did have some handouts that you could look at. This gets really small on the screen, so I did send out a copy of this FinPac financial statement. It says Sample Farms balance sheet. This is a balance. Sample Farms is a farming operation that we put together several years ago for Annie's project, where we took a beginning farming operation. We've kind of rolled through the years with it. This is the statement that we did last January. You can see at the time we had corn at 430, which it's still higher than what it is now. But it's certainly not as high as it has been in past years. And soybeans were over $12. Right now, I think I looked at the Eddyville price on soybeans for January. It's $9.99. So that's we're the statements that are done this winter might be substantially different than what this statement is showing. This was done last January. They had cattle. They had crop inputs that they had paid for already, and so their current assets were $304,772. Their current liabilities, as you can see here, we're showing interest that's accrued. We're showing payables that are out there, as well as the balance on their operating loan. And then we show the principal that's due on the cow loan, machinery loan, and real estate loan. Showing all those items gives us current liabilities of $184,433. Intermediate assets, if I look at those, you can see that the intermediate assets are $970,500. And the debt against those assets is only $147,916. So that's a really good intermediate position. And that actually gives us some flexibility if we have to do some refinancing, which as we go through the cash flow with the prices we've got right now, you'll see that might be a possibility for this operation. But I look at that and I realize there's room to do something if I need to do it with this operation. As far as long-term assets, real estate value of $1,008,000 and liabilities of $490,114. That's still a very strong position. But again, when looking at this statement, my immediate response, if there's a bad year or a soft year for this operation, would be to work on refinancing the intermediate assets, especially since those are at more current interest rates. This farmland loan is at 4.5%. I would hesitate to touch that because you can't match that interest rate right now. So I look at that balance sheet and I try to then work with the ratios that come strictly from the balance sheet. The liquidity and solvency ratios come from the balance sheet. And that current ratio is the current assets divided by current liabilities. It tells me if that operation can cover those current farm liabilities once those assets are sold. Now, the timing might not be exact. It might be that you have a bill that's due and you're not yet ready to sell corn. That's what that operating line of credit can help you cover. But the theory is that within the next 12 months, those current assets should cover those current liabilities. And when you do that, when you compute that ratio, The higher the ratio, that means the more liquid the operation is. That means the greater the capability to handle those debts as they come due. The solvency ratio, that's the debt to asset ratio. And as I said before, it does kind of tell you if something happens where you have to liquidate the farm operation, maybe there's a health issue or a debt, how can that operation handle all the debt that's out there? And there again, it's important for us to see that. This is a little bit opposite, though, from the current ratio. Here we want a lower number. The higher the number on the debt to asset ratio, the higher the risk is. So if we go ahead, I've gone ahead and done the calculations for that sample farm's balance sheet. On the current ratio, we had those current assets of $304,772. We had current liabilities of $184,433. When I make that division, I come up with 1.64 for our current ratio, which is much more typical of what we've seen with a lot of operations over the years. In 2012, the last 2 years, we've seen current ratios that are much higher than that, but that's because of some very high prices that we had. Debt to asset ratio. If I look at the sample farms debt to asset ratio, I take the 822,463 of total debt and divide that by the total farm assets, and I come up with 2,283,272. Make that division, and it's 36% debt to asset ratio, which is very strong. There's a lot of borrowers that I have worked with over the years that have not had that strong of a debt to asset ratio. Most banks, they'll be working with people somewhere between, that 36% and maybe 55 to 60% debt to asset ratio. Those are traditional customers of banks. I will tell you that as interest rates go up, the higher your debt to asset ratio is, the harder it is for you to handle those higher interest rates. So if you have a very high interest rate or high debt to asset ratio right now, hopefully you have some interest rates that are locked in. If not, FSA, Farm Service Agency, used to have an interest assistance program. It's still on the books, but it's currently not funded. And we've made some inquiries as to whether they could start funding that program again. That can help buy down your interest rate. And so that might be something just to kind of keep aware of, stay aware of, watch for news clips to see if that actually happens when the Farm Bill is passed, if it gets passed. So there's a lot of lenders that put emphasis on working capital as a percent of farm revenue. And I think that's a good ratio, but I just wanted to show you how much it can fluctuate over time and how different it can be for the different types of operations that are out there. And the same thing is true with the current ratio. I always try to have my cow-calf producers come in as soon as possible after they harvest their crops, just because that's when they have their largest hay inventory. And they don't have any calves on the ground yet, but they have all their hay. And so if I'm taking that statement December 1st, their current ratio, just like their working capital, will look much different than if I'm taking that statement February 15th and they don't have any calves that are born yet, but they've fed up most of their hay. So if you've got a cow-calf operation, it's largely cow-calf, go in as soon as possible after crops are harvested, just so you get a better picture of what your current position is. But again, as I show you here, there's a lot of fluctuation between what's acceptable and desirable between different farm operations. And so I look at that, but I don't emphasize that as much. I work more with the current ratio. And with that in mind, I say Ryan Drollette has some information prepared to show you how, if you want to do your own balance sheet, you can kind of put one together using some of the documents or tools that are out on Ag Decision Maker. So Ryan, I kick it off to you.
Okay, thank you, Leslie. I'm going to share that one. Okay, so Ag Decision Maker is where Iowa State University and the farm management team put all of our spreadsheets when we look at farm management topics and anything of that nature. We're going to throw it onto the Ag Decision Maker webpage. So this is the homepage. Use your favorite search engine to find Ag Decision Maker. It is extension.iastate.edu /AGDM / that's it. All right. So we're here on the homepage. Where I'm going to go, sometimes for individuals, the best thing is to just type in the search button up here on the top right. For me, I'm going to go to the whole farm menu and down to financial. When I get to the financial tab, things that Leslie has already started talking about, and we think about, I've got a whole document on financial terms, understanding the cash flow analysis, 12 steps to a cash flow budgeting. I've got several things that you can click on to learn more about and go more in depth. If you're looking at just the web page, you can click on it over here. I've got it in PDF form on the right. And then there are several Excel spreadsheets that we can download and use, especially as we're looking at preparing a balance sheet, preparing a cash flow statement, and any other analysis that you might want to think of. I've got several spreadsheets scattered throughout the entire web page on different topics. But today we're on the finance side. So a few of the tabs that I've opened up, the 12 steps to cash flow budgeting. If I go to 12 steps of cash flow budgeting, I've clicked on it. I can get the PDF. I can go to the cash flow budget with multiple enterprises. There's even a video that we've got, as well as for community colleges that use this, there's a teaching activity as well. So going through cash flow budgeting, we're going to get there in a second. First, we're going to back up and go to the net worth statement. So the net worth statement, again, clicked on it. You've got two different Excel spreadsheets that you can look at. There's more information. Leslie made the comment, well, my assets minus my liabilities is my net worth, or on the other side, assets equal my liabilities plus my net worth. So however you look at it. More comprehensive information as we scroll down through. I'm going to pull up the basic, the net worth statement, just a very simple one. I've already downloaded it, pulled it up. It's just one page. So putting things into a net worth statement. We've talked about current, intermediate, and long-term assets and liabilities. This sheet actually only goes through current assets and fixed assets. So I'm going to say take your midterm and your long-term assets and liabilities and put those into the fixed side. The current ones are all going to go in the top box here. So this is just an example. I'm going to start off putting in your name, putting in the date. What is today?
12.
12. It doesn't like me. It puts a number in. Oh, well, we'll delete it. Usually we're going to date our balance, our net worth statement. As Leslie made the comment, depending on what type of operation you have, if you're a livestock operation versus crops, maybe depending on that livestock operation coming in right after you're finishing harvest. For a lot of individuals, they're going to do this on a yearly basis. You're going to do it on a yearly basis, same time frame every year, right? For most individuals, they're also going to be looking at this at the beginning of the year. I've got a few colleagues that they always kind of tease me and say, "Hey, Ryan, did you get your net worth statement or your balance sheet put together January 1? Individuals that I work with that are just on the crop side, it's like every year, January 1, on New Year's Day, he's going to sit down, he's going to write up his net worth statement, his balance sheet, where am I at? And they're going to use that to compare where have I been and look at where have I been the last 5, 10, 20 years compared to now, and how does that change? Right. So this is just really simple. I started adding things in. Okay. Number one, I've got a bank account. Some days I wish I had $120,000 in it. This balance sheet or net worth statement actually has, I can put in the cost value, what the current value is, or I can put in a market value. I've got my liabilities on this side. So I've got an operating note. It's going to be due this year. It's got a market value of $20,000. On my bank account, it is what it is. Cost and market value are the same things. Getting down into some of the maybe more long-term assets, so I've got a piece of farm ground. I call it the clay field, right? Again, cost value, what it actually cost me. Well, I just bought this here this last year, so my cost value and my current market value are the same. But let's say I've got another piece of ground. I call this the cow field. My cow field, my cost value, what I paid for it, well, let's say I only paid $40,000 for that one. But my market value today for it If I turned around and sold it today, maybe it's worth 60,000, right? So there are opportunities to put into this balance sheet where what I actually paid or what the current market value is are two different things. So we can, like on machinery as well, we can say, well, what is the cost value? What do they pay for it? And what is current market value for it as well? So in situations like that, let's say I have a combine. My cost value, what did I pay for it? Well, let's say I paid $420,000 for it. And market value today, if I sold it today, maybe I'd be lucky to get 250,000 out of it, right? So there are situations where what I paid for it with depreciation and what the actual market value today is might be less. Sometimes it might be more. On the liability side, let's say I've got a machinery. I can type today, machinery. I can't even type. Let's say I've got a loan on machinery and I've got 150,000 of machinery expenses that are long-term. If I've got whatever notes that are due in the current year, and you really can't even spell today. Let's say this year's on the note, I've got a payment of 50,000. Okay. So current liabilities, anything that is due in the current calendar year in the next 12 months. I've got a machinery cost down here saying, well, this is the amount due in the next 12 months. This is the amount due after I make my payment in the next 12 months that it is due next year and beyond. Okay. So when we're putting everything in, and I would say as we're going through the assets and liabilities, the more detailed you can get about your farming operation, the better off it's going to be. On this spreadsheet, like I say, this is just really simple of what are the assets and liabilities left and right. It's going to go down, and based on total assets, total fixed, and total liabilities, it's going to calculate out that working capital, the current ratio, the debt to asset ratio. You can even put in there and say, well, what was the net worth last year on the cost and market value? And it'll say, well, what is the change in net worth statement as well? So Leslie, quick question for you. You said debt to asset ratio, the lower that number, the better off I am. High number. If I've got a 71% debt to asset ratio as a banker, what would you tell me?
I would be a little leery of the amount of debt you had. But again, I think it's very dependent on what your actual payments are and your ability to handle those payments. If you've bought land recently, it would not be unusual to have a much higher debt to asset ratio. Right. If you bought it at 3.5% with a farm credit loan, and you have 25 years on it, it might be very manageable. So I'd watch that. The higher that ratio is, the lower you want your average interest rate to be. So that's important.
Yeah. And so this is just a really quick and simple balance sheet, net worth statement. We've got the more comprehensive one, and I'll pull that one up here. And this is the one where it goes through the different schedules, right? I'm going to start off with the Schedule A, farm checking, savings, hedging account balances, right? Plugging in all of the different accounts that you've got, beginning balances. Crops held for sale or feed as well. You know, what crops have I still got sitting in the bin? What hay have I got sitting out in the shed or along the fence rows? What, right? Am I going to use it? Am I going to use that for feed in my livestock? So this is the more comprehensive balance sheet, where I start off with my beginning schedules. I do an ending schedule as well on this one. So this is covering a time frame, saying, well, this is one where I sit there and say, if I'm doing this one every year on January 1, then I can take and say, well, what is the beginning? January 1 for the 2025 year. That if I did this January 1 coming up this year, 2025, this is my beginning, which also then becomes my ending schedule for the one that I filled out the year prior. Right. So then I can sit there and it can do a beginning net worth statement and calculate out what it was at the beginning of the year versus the end of the year. Okay. And also then looking at income, expenses. So everywhere there's a yellow box on these spreadsheets is where I'm going to be plugging in numbers. Okay. So looking at the income, the cash flow, how did that cash flow happen throughout the year, what the equity is, and then again, so then all of a sudden I'm looking at farm net worth beginning of the year, change in market value of the capital assets, and going through each one of those because I'm sitting there going, well, on my beginning schedules, I've got market livestock, supplies on hand. Let's go down my breeding livestock. And so this is where I get down to my machinery and equipment, my buildings and improvement, my farmland. My farmland prices might have, like the market value of farmland or market value of equipment might have changed, even looking at the depreciation that's in there compared to the ending schedule as well. So then it's looking at whatever the equity is, net worth beginning of the year, change in the market value, and then trying to get back to that performance in the bet and looking at benchmarks based on other Iowa farms as well. So then it gets into that liquidity, solvency, profitability, return on the assets, return on equity of the farm, and then the financial efficiencies to help an individual sit there and go, well, how am I doing? As Leslie said, that's some of these exact same numbers are going back. Your lenders are going to be looking at some of these and trying to help you go through that balance sheet, looking at it going, okay, where are we at? What's the return on these? So the other thing that we pull up, I said there was the 12 steps to cash flow, right? Cash flow budget instructions. Here's the spreadsheet on the cash flow. This one gets set up where you have different periods and you can change these. There are 2-month periods. I've got them set up as January, February, and you can 6 period November, December, and you can change these here at the beginning. But it goes through multiple enterprises. You've got livestock, crops, overhead, capital assets, financing, and the whole farm budget. Now, each one of those, there's a tab for each one. You would go in and in the cash flow statement, sit there and say, okay, how did it? You can do this in 2 ways as you go throughout the year and say, well, what was my cash flow from this past year? And also do one as a projection looking forward, especially saying, well, I need so much to pay off. I expect to sell off livestock. I expect to also cost per unit, like where are my costs going out as well as the revenue coming in. So I've got one for livestock, the crops, the overhead, and it goes through each one of these on the different time periods as well, saying, this is helping me understand what are my cash flow needs throughout the year. And do I have time periods where I need a lot more cash to pay expenses, right? As we look forward. So cash flow budget, and like I say, and balance sheet, and all of these come off of the Ag Decision Maker webpage. And again, on the financing tab. So profitability, cash and accrual. If you want to really get even further into it, the accrual statements versus cash statements as well. We'll leave that one for another topic for another day. Okay, Leslie, I'm going to pause there.
Okay, so I can get my screen to share here.
I'm going to grab a bite. I shall return.
Sorry, I was going to put in a plug for how great the Ag Decision Maker is. 2 things that I really reference there, just generally for our office are the cash rent values. And then they also have a template for farmland leasing. So if you are interested in more information for that, the Ag Decision Maker just has all sorts of really great information.
Yeah. Another thing that we look at every year, the extension economists prepare estimated budgets for crop production as well as livestock production. And when we're sitting down and trying to encourage somebody to give us information on what they're spending for inputs, we encourage them we print them out, actually, a copy of those budgets, because there's a place where they have some of the average numbers that extension uses, and then they have blanks, so you can put in your own expenses. But it helps people to think about, oh yeah, I do have to put in a cost for chemicals, or I do have to put in a cost for supplements for my livestock. Those kinds of things. I think just it's a little bit of a cheat sheet to help people think their way through their own operation. And then that's good information for me to use with FinPac or again with Ag Decision Maker. The FinPac program that I use is with the Farm Financial Planning Associates. I will tell you though that I have used that program since 1980. It's a very good program, and it helps lenders work through. We don't just do one balance sheet or one cash flow. We have to do 100 plus usually every winter, and so it works a little bit faster for a lender than what the forms on Ag Decision Maker do. Some lenders use a completely different type of program for analysis. Sadly, there's a few that there's a Moody's program that's really used for commercial loans, and it's not good for ag loans. It doesn't handle agricultural credit very well. But again, it's a bigger bank. That's what they're used to using. And so they're kind of set in that way. So again, if you can use Ag Decision Maker to fill something out to take in, that might be beneficial for those banks that aren't using real ag lending software. So do you have any other questions, Lauren, at all? Or
No, not right now.
okay. Oops, let's see if we can. There we go. So Ryan had mentioned some of the things that go into preparing income statements and cash flows, as well as the balance sheets. The thing that I always caution people are to make sure that they match their income and expenses. So if you're producing a corn crop or soybean crop and you're going to show the income from that crop, make sure you show all the expenses. The same thing with calves. If you're selling calves, make sure you show all the expenses that are involved with producing those calves, your feed bills, your vet bills, those kinds of things. If you do that, if you do a good job of that, then I can come closer to preparing an accurate cash flow. We also ask people or encourage people to be conservative. If your average yield is 190 bushels over the last 5 years, don't plug in 210 just because you need to do that to make this thing work. Be conservative for yields and prices. And then, as Brian has shown you, you can use those Ag Decision Maker worksheets to kind of work through a couple of scenarios. Maybe you want to use, sadly, again, Eddyville has $4 corn for new crop corn for 2025. Maybe you want to look at that, and you maybe want to look at what happens if corn is 425. You can do that with those Ag Decision Maker worksheets, just like I can with the FinPac worksheets that I use. So that income statement, if you have your lender saying we need a pro forma income statement, that's just a fancy word for a projected income statement. And so they just want to know what you're projecting your income and expenses are going to be. Simply that. They might want historical income statements. Usually they ask for past tax returns, which again, they're on a cash basis. And I've got a chart here that I'm going to show you where that can be very misleading. But that income statement is going to show all your revenues. It's going to show all your expenses, except for your principal payments. It also will not show your family living expenses, just like the income side will not show your off-farm income. The one thing it does do is it does include a charge or cost for depreciation, which gives you an idea of the machinery wears out a little bit every year, and eventually you have to replace it. So that income statement actually does include a charge for depreciation. And as I said, cash versus accrual, that those Schedule Fs are pretty much always on a cash basis. I try to work with FinPac so that I'm doing more of an accrual-based income statement. Basically, by doing that, I'm accounting for all those expenses and all that income within 1 year time period. And that does give me a more accurate picture of what you're going to actually have happen to your operation over the years. There's a chart that was put together by the University of Minnesota, and they don't have a current version of this chart, but it shows you, as you can see over the years, there's been big differences from time to time between your net cash farm income and your accrual-based net farm income. Usually in years where prices are going up, that accrual farm income is going to be much higher. And when they're going down, it's going to be lower than your cash farm income. So again, looking at what happened in 2021, it's also happened in 22 and 23. you probably had a higher accrual farm income than you would have had cash. So if you're looking just at historical information and only using that could fake you out for the year ahead. You want to look at what that operation is going to actually do and not just look at the historical information. But you can see there's big differences. And it's important, I think, and I know Ag Decision Maker has a worksheet where you can take your beginning balance sheet and your ending balance sheet and your Schedule F and kind of adjust it to an accrual-based income statement. If you really are inclined to do that, go for it, because I think it's very informative. I remember one year, we had an operation that was showing, Schedule Fs that they made like 25,000 one year and 15,000 the year before that, and then 35,000 the year before that. And that was just their Schedule F. And I went through and adjusted it. And they actually have been losing money every year. What happened is they had a huge grain inventory when it started out, and they kept selling down on that grain inventory every year. And that was how they showed a positive figure on their Schedule F. But in reality, they were losing money because they were reducing that grain inventory. So try and make those adjustments if you can. So if you look at the cash flow, there's a handout that's marked Sample Farms 2024 crop year. And I actually did this a few weeks ago. I put in more current prices. I tell you, I started out the year at $4.60 corn and $12 soybeans. And, we're not anywhere close to that right now. I did adjust those prices down. You'll see that as we go through this. But for any cash flow that you're preparing, it helps to know, what your cash rental terms are if you cash rent ground, how many acres of crop ground and hay and pasture ground you have on your home farm, what your livestock numbers are, what you've done as far as calf sales. Here I have that you're selling 0.85 head for every cow that you have. And that's because this is an operation that has a 95% calf crop, and they're keeping back 10% of the calves as replacement heifers every year. So they're not selling, for 90 cows, they're not selling 90 calves. They are keeping some back, and they do have some death loss. For yields per acre, actually, when I started out the year, I'm from South Central Iowa, and the yields, we do have some clay in our soil around here, so we maybe don't have quite the yields that they might have, around Story County or Grundy County. But I had used 180 bushel corn and 54 bushel soybeans. I pumped that up a little bit. I will tell you that locally we've had a couple early soybean crops taken out, and one guy had 70 bushel plus on his beans. So that would help a lot considering what prices have done. But again, you want to be conservative when you're projecting this. My tendency with FinPac is to separate owned acres from rented acres. So this example operation, they rented 700 acres, half corn, half soybeans. So that's where the 350 is on this chart. And then they had 50 acres of corn ground, 50 acres of soybean ground, and 120 acres of hay ground on the farm that they owned. So they rented more hay ground, and they rented pasture ground for their cow herd, which is what a lot of people wind up doing, is renting quite a bit of pasture ground. It's tough to get it anymore, but there is a lot of pasture acres that are out there that sadly don't have fence on them. If you can fence them in, you might be able to get a decent cash rent on them, but it's oftentimes it's necessary to do that to support your cow numbers. So anyways, we look at that information, the acres, the yields, and then we also collect input costs, how much you're paying for seed, fertilizer, chemicals, any fungicides that you're putting on. We look at what your crop insurance costs are, and we plug those into another worksheet that all flows into this FinPac. And collecting that information, looking at the Schedule Fs to see maybe what you're doing for property taxes, for health insurance, some of those things. Granted, those costs have been going up over the last few years, but they do help us to see what those costs have been in the past, so we can project for this next year. And so FinPac will take that information. If you look at the second page of your handout, you'll see this income statement. And it's really an accrual-based income statement because of the way I've put this information in. We're selling our corn at $4.50, our soybeans at $11.25 on the average. which is only going to happen if somebody forward contracted some crops. Again, we've got $4 corn and $10 soybeans at Eddyville and ADM and Des Moines. So you certainly can't get these prices right now. Hopefully we'll get some yields that make up for it. From what I've seen so far, what I've looked at so far, I think our yields are going to be just high enough that we're not going to collect any crop insurance in spite of the low prices. So sadly, we're not going to maybe get some much off-farm support from our crop insurance, but at least it's been there as a safety net. I did not change. I was using 240 on calves in the at the beginning of the year. I didn't change that. We all know these prices are much, much higher. They're in the $2.90, $3 plus range on calves that are being sold right now. So it's, that certainly could offset, if I had plugged in those higher numbers, that could offset some of the losses that I've plugged in by using lower prices. But I left them alone. Anyways, we look at total income of $831,630. Total expenses, and this includes interest. If you look here, you'll see there's an interest figure of $81,655. I point that out because we're going to be using it later on in some of our projections or some of our ratio calculations. But total farm expenses, cash farm expenses, are $766,575. So our net cash farm income is $65,055, which that's the money that we're going to use to pay income taxes, family living expenses. We're going to use that to pay principal. We've already accounted for the interest. We're going to use that to pay principal on our loans. So, we're looking at that. But if we take depreciation into account, there's really not a lot of net farm income. It's only $1,630. So there's a dramatic drop once we take depreciation into account. Now, depreciation is a non-cash expense. You maybe don't have to account for that this year. Maybe you account for twice as much of it next year, but you do want to kind of keep it in mind that if you have to replace machinery, once you do that, there's not a whole lot of money left over. So with that in mind, looking at that income statement, there is a ratio that I take from that income statement and then from some prior information on that balance sheet, and that's the profitability ratio. Again, I think the importance there is you have to be profitable to stay in business. And you don't have to be profitable every year, but you have to be profitable the majority of the years in order to stay in business. ROA, which basically measures what your return is on farm assets, it allows you to discount the value of labor and management that's contributed to the farm. It also allows you to adjust the revenue generation for assets, irregardless of whether they're owned completely or whether you're buying them with a loan. So in order to make that adjustment, you're going to take your net farm income and you're going to add back the interest that's been paid. You just want to know what the assets are doing. You don't care if they've borrowed money for those assets. You don't care what labor or management has contributed. You just want to know how well the assets are doing to contribute to the farm profitability. So if I look at that, net farm income of $1,630 and I add back that interest of $81,655, and then what I usually do is I subtract out family living expense. Technically, there's a calculation that you should make that accounts for so many hours of labor and so much return to management, but that's pretty complex for most banks. And what they will do instead is just say, you know what, you're taking $60,000 out for living expenses. We're going to use that as the value of the owner withdrawals. Calculate that and then divide it by the total farm assets of $2,283,272. And that ROA is 1.01%, which does not seem like very much. We had a lot of 1% returns in the 80s. We've had some 1% returns from 2013 to 2019. It's not a lot, but at least there is profit there. And I will emphasize that ROA, your profitability, will vary greatly depending on what your corn and soybean prices and cattle prices are. The higher they are, And the lower your expenses are, the better that ROA is going to be. And so again, when I'm teaching the lenders at the Ag Banker School, I talk to them about this can fluctuate. Do not make this the sole determinant on whether you're going to grant the loan or not. Look at what the operation's done in the past and see what the impact of prices has been to determine what maybe average profitability might be versus what it is going to be for the next year. But it is something that I do look at. It was something that we used in our loan pricing formula. And so because of that, we did make that calculation and it got plugged in. The higher the ROA was, the more profitable the operation was, and also the lower interest rate they got. We did adjust that every year because, as I said, as prices change, what is considered an average return on assets, that will change as well. So we kind of had a grid that we would adjust every year depending on prices. But again, what that ROA was would help determine interest rates that borrower might pay. So the other ratio that I use from that income statement and the balance sheet is that financial efficiency ratio. And again, there's actually 4 of those ratios. I just use the operating expense ratio. And it just really tells me, how much expense it takes to generate $1 worth of income. So the closer that ratio is to 100, that means it costs more and more to get that $1 worth of income. The lower that ratio is, that means that operation is better equipped to handle setbacks in yield or prices and survive. It's more resilient. So to do that for this operation, what I would do is take those total cash farm expenses of $766,575. You add back the interest, and then divide it by those gross farm revenues of $831,630. I come up with an operating expense ratio of 82.4%. Again, that tells me it takes 82.4 cents to generate every $1 of income. That's towards the high end of the range. We've certainly seen that within the past 10 years. But I personally like to see that down closer to 70%. That's a much more comfortable level. Again, if this is really high and you have high interest rates overall, it makes it tough for an operation to survive. The other thing is once it's at 82%, again, it's taking 82 cents for every $1. That means that your crop insurance, if it's at 75%, doesn't maybe really cover all the risk there is in producing that crop. You may need to go more with an 80% coverage, which costs you more, but it gets you closer to that level that you need to cover those expenses. Just as an extra caution, if you have a lot of cash rented ground, this ratio is going to be much higher. You see, when I'm making that calculation, I'm adding back interest. So if you have money that's, if you have real estate that you're buying on credit, that interest, because it's added back in, it kind of discounts the true cost of that real estate on your operating expense ratio. And so people with a big base of owned ground will have a lower operating expense ratio than someone who's cash renting all their ground. So if you are a beginning farmer and you're cash renting all your ground, point out, if your lender makes an emphasis of this or tells you they're concerned about it, point out the fact that because you cash rent your ground, cash rent is included in those operating expenses. It does distort that ratio. And that doesn't necessarily make you a bad credit risk. It's just that you are going to have an operating expense ratio that's higher. So I've always liked this cartoon because sadly it's closer to the truth than what we want to realize. We found out in the 80s, we found out in 2013, 14, 15, that if you have an operation where your net worth has increased dramatically over the past few years, you would be surprised how when you have years of loss, how fast that net worth can decline. And usually it decreases faster than it ever increases. So some of these large operations with a lot of cash rented ground, if they're paying high cash rents, they could potentially lose a lot of money this year and they might really spiral down. Sometimes it's hard to get ahead of that spiral, but if that's the case, if you lose a lot of net worth this year, really take a hard look at what you're spending for cash rent and some of the other things and try to alter some of those terms so that you don't spiral down before you can get ahead of it. So repayment capacity, I talked about that ratio a long time ago. That is pulled from your cash flow. And when I worked with the Farm Financial Standards Council, we had a big discussion on income statements versus cash flow statements. And the economists in the room, they were very concerned about having income statements. The bankers in the room said, we don't use that to determine whether people can pay for loans. We use the cash flow statement. And there's a difference in the two. Some of the similarities are we use the same yield expectations, we use the same marketing prices, we do include all the expenses for producing crops and livestock. But unlike the income statement, when I'm doing a cash flow, I take into account any off-farm income. I also take into account living expenses for that family and income taxes that they've got to pay. And I do not include depreciation. Again, it's a non-cash expense. It's not something that you really take out of your pocket every year or have to put in a separate account to fund replacement. It's an economic cost, but it's not a cash cost. So those are the changes that I make when I'm doing a cash flow statement versus what you have in the income statement. So if you look at the third page, halfway down on that FinPac cash flow, you'll see the repayment capacity, the cash flow that's actually calculated in. And what FinPac does, it looks at the net cash farm income. Again, it says depreciation is a non-cash expense. We don't care about that. We're going to look at the cash farm income because that's money that's out there for paying principal and living expense and income taxes. It adds back off-farm income. In this case, we had an off-farm income of $48,000. We had family living expenses of $60,000. And FinPac calculated that this operation will pay $5,339 in income taxes. What that does then is come up with money that's actually available for principal payments because it says, you know what, you're going to pay your income tax and your family living expenses before you ever pay the bank. And that's true. You do that. So it comes up with $47,716 that's available to make principal payments. And nobody knows what just their principal payments are. They know what their principal plus interest payments are. So FinPac will then take that $81,000 that it took out, it adds it back in and says this person has $129,371 to pay on their principal and interest payments and to pay their operating interest. So it then subtracts those items out. Again, if you look back to the balance sheet, you can see that these are what the payments were on these three different loans, calculated operating interest. And then it came up with $156,430 of total principal and interest that has to be paid. So as you can see, there is not enough money to pay that. There's going to be a deficit of $27,059 that this operation is going to be short in getting all their payments made. So if I was doing this cash flow as a lender, I look at this and I realize, so this number here is actually, from an aggregate amount, 27,000 is less than this 47,000 that we had for principal payments. So that tells me that operation is actually able to pay all its interest, but just a portion of the principal. So I look at that and I say, okay, do we need to extend payments? Do we maybe just pay the interest on the cow and machinery loan and we push all the principal payments back a year? Basically, you're adding a year to the note. But is that something we can do that helps that operation this year? And it probably is. But then I also want to look and see what those payments are. I mean, they'll be the same next year. And if I plug in, what the income potential is for next year, are they still going to struggle making those payments? If so, I might want to completely reset those payments. Instead of having the 3 years left on those notes, I may want to reset them for 5 years so that those payments are lowered. But at any rate, it's important to me to know that, yes, they're paying all the interest and they're paying a little bit of their principal. The other thing that I might look at is, I might say, hey, prices, if they were going to get better, if there was a prediction that prices were going to get much better next year for some reason, I might say, you've got enough operating or enough working capital. You've got quite a bit of room there. Let's just go ahead and make those payments. You're going to wind up borrowing more on your operating note next year because of that. But, maybe we can kind of work our way through this and we'll just leave everything alone If we have to refinance, we can do it next year, and hopefully, interest rates will go down. So there's different things you can do, but this negative figure tells me I should be discussing things with that borrower and developing plans for how do you cover that shortfall. And if I don't do it, the examiners, when they come in to examine loans in the bank, they're going to ask me how that guy's doing it. So it's better to work it out with the customer and have a plan, instead of letting the examiners dictate what that plan is. So Lauren, I don't know if you have any questions, or Ryan, on that. It's a lot of information in a short amount of time, but that's kind of how I would handle it. Again, I point this out so you can be proactive on your own account. If you put a cash flow together and it shows that you're going to be short on your payments, be prepared to talk to your lender about, this is my plan for handling that shortfall. If you need help in figuring it out, if I restructure these loans and I pay them out over 5 years, what's that payment going to be? If you're not comfortable in asking your banker that question, you can call one of the Farm Financial Planning Associates and they could recalculate what those payments would be for you.
And I'll just cut in, Leslie, and just make the comment is when individuals get into that issue of not being able to make payments, the best thing is to contact your lender, right? And
absolutely
sit on it.
Yeah. And really, the sooner the better, because once you get into winter, that gets pretty busy. But if you think you're going to be short, if you did a cash flow last winter and you had $4.80 corn and $12 soybeans, and you're not going to have that, and you don't think the yield's going to make up for it, go in and talk to that lender and say, this is what I'm thinking I'm going to get for crop revenue. I'm concerned that won't cover all of my payments. Do you have any suggestions? Is there something we can do here? And the sooner you go in, the less workload on that loan officer. So the more thought they might actually give to it, because they have time to actually think about it and work with you on it. In the middle of January, they're very, very busy and they're trying to move from one loan to the next. And so they may not give you quite as much quality time. So did that cash flow. The reason I do that cash flow, first of all, make sure you can cover your payments, which you really can't here, but also to help me calculate what's called the debt coverage ratio. And that just provides a measure of your ability to pay your loan back. The higher that ratio is, the better your ability to cover payments. So when you're doing that, it's a very complex calculation. And so I walked through it using the information from that sample farms cash flow. And in doing that, hopefully this helps you work through your own operation. But you use the net farm income, you add back depreciation, and then you'll subtract, and you add back interest. Then you'll subtract out family living expense and taxes, and you'll add back in off-farm income. So once I do that, I divide that by the debt payments that are out there. They're $156,430. I come up with a debt coverage ratio of less than 1. This tells me that in this operation, they only have 83 cents that are available for every dollar in debt that they have to pay. And that's not a good position. Again, when I see this is where I really laser focus. It's like something has to change in this operation. Either they need more income going forward, they need an adjustment in their debt payments, but something needs to change for this operation to continue from year to year. And they can add more income. Maybe they do some custom work. Maybe if they have cash rents that is, eating away at their profitability, maybe they can adjust some of those cash rents. But again, this to me is that little red light that says you have to do something with this farm operation. And we've had years in the past where that debt coverage ratio might be 1.5 or 1.7. When I see that, it tells me that person has $1.50 or $1.70 available to cover every dollar in debt that they have to pay. That's a pretty comfortable position. This 83 cents is very uncomfortable. So again, I feel like that's an important ratio for not only your lender to look at, but for you to look at, just to kind of get a sense of how much room you have or what your capacity is to handle changes in income or yield. Another caution I want to throw out. So if you're growing your operation, you've added several acres, cash rented acres this year, and you haven't really showing the income from those acres, but you certainly will show the expenses. Or maybe you've kept back extra heifers. Make sure you tell your banker about that growth change, because that does have an impact on some of the numbers they're going to calculate. I remember a borrower that I worked with years ago that was keeping back a large number of heifers, and it did impact his Schedule F, and he started working with another lender in our bank, and they're like, "Well, you're losing money," and he's like, "What?" And he'd been making all of his payments and everything; he was fine, but they were really concerned because he was showing this big drop in income. And they were not accounting for the fact that he was going to have more calves. So, I met with that lender and said, okay, you've got to account for the fact that these heifers are now going to calve, and you're going to have calves this fall to sell. Here's that impact on his cash flow. Oh, looks much better, right? So if you're changing your operation, growing it, make sure you let that lender know so that they can adjust their cash flow expectations accordingly. So I included this chart. This is a chart I shared with the ag bankers this year at their class. And I share it with you again. You might even want to give it to your lender. But this basically, it's backdated a little bit because I want to show what happened to some of these ratios between 2012 and 2021, because we might have a period where we have declining crop prices for several years. And if that's the case, it does have an impact. As you can see, 2012 was a year of very high corn prices. 2013, they were still high, but they tailed off in 14, 15, 16, 17. They really fell off. And because of that, you can see, like, if you're looking at this current ratio line, you can see how that fell off, over the years as crop prices dropped. You can also see that working capital fell off. They really declined. So from that standpoint, I guess I share this in hopes that as a lender sees this, they realize, oh, things, current ratios can go down and then they can start back up again as prices improve. That's the cyclical nature of agriculture. And for younger lenders that maybe haven't seen this happen before, it's important for them to see charts like this and realize that you can have an increase in your debt to asset ratio. And then as prices increase, you can drop that ratio. I've been through, I don't know if I want to say unfortunate enough to be through cycles like this that happened, 2012 to 2020. We had a similar dip, 2000 to 2008. We had the dip in the 80s. I mean, we've seen this happen numerous times in my lending career. And if you're patient and you work with your customers, usually they can work their way through it, and you can help them do that. But again, you've got to be aware that things can go down and go back up again. Net farm income, same thing. You see how it fell as prices fell. And ROA, we had 10.6% on average with this group of farmers. These are the Iowa Farm Business Association farmers, but they had a 10.6% ROA, but it fell down to a little over 1% in 2015. So again, that can drop. Look how that went up in 2020, 4.5%, 11.5% in 2021. That's because of government payments that came in. So again, that fluctuation is important. And then the operating expense ratio. We had a low of 58%, peaked at 80%, then it dropped back down to 54% in 2021. Again, government payments help that in those latter years. And there's a chart that's out there on Ag Decision Maker that will show like 2022 and 2023, but you missed that 2012 and 2013 on that chart. So that's why I've backdated this or gone back with the older chart, because I think it is important to see that drop and then that improvement. And please share that with your lender, especially if it's a younger lender, because they may not have seen that. They may not appreciate that. But again, if you're advocating for yourself, it's important to share that information. Interestingly enough, the Iowa Farm Business Association, they do not show the coverage ratio on here because they don't have a way of tracking what people's debt payments were. They just track the overall debt of of their and overall current liabilities of their borrower. So they don't really know what the payments are. And so they don't calculate that ratio, but they do calculate the other ones. I've also included this farm financial scorecard. I think it's really nice to have this. This was developed by the Farm Financial Standards Council over the years. And these are more what I would call more normal parameters for these different ratios. The red, yellow, green, green indicates that the ratio is very strong. Yellow is kind of a caution standpoint. And red, it means you might be subject to some hardships. So because of that, I think it's a helpful chart, again, just to share with your lender, but also to keep them from getting overly concerned about where some of the ratios might be right now. Because we just had some years where we had some really, really strong, out of the norm kinds of ratios. And it's important, I think, to reset that lender brain in terms of what is more normal, because we're going to see some dramatic changes compared to those high years. So for example, that current ratio, somewhere between 1.3 and 2 is, okay, it's a little bit of a concern, but you're still not vulnerable at that. Remember, we had 1.6% or 1.64% on the calculations that we did on sample farms. They're kind of right here in the middle, so they're probably okay. The solvency ratio, I was at a meeting last spring where the farm credit people basically said, if your debt to asset ratio is over 35%, you're in trouble. That is not true. It all depends on, what your cash flow is showing, how much of your interest rates are fixed and those kinds of things. Most lenders are actually working with borrowers in that 30 to 60% debt to asset ratio range. So you're probably okay if you're in that range. If you're a little higher than 60%, as Ryan and I talked about earlier, I would like to see, what your actual payment schedule is, how much of your debt is at a fixed interest rate before I hit the panic button. And if you're under 30%, you're really strong. You're probably not talking to your banker very much. So, that's the parameter there. Again, the lower that number is, the stronger you are. For ROA, the higher that number is, the stronger you are. And you can see traditionally, we've been in that 4 to 8% range. We're going to be less than that probably for this year and maybe next year for a lot of operations. But again, that's very dependent on what prices for crops and livestock are going to be. It has a huge impact on that figure. So we do have ups and downs because of the cyclical nature. And last, that financial efficiency ratio, again, in that 60 to 80% is kind of normal. I kind of like to see it 70% or below. I don't know that I've seen it actually drop below 60% very many times. It's usually in that 60 to 70% range for the operations that I've looked at. And repayment capacity, we certainly want it to be more than 1. 1.25 to 1.75, it's $1.25 to $1.75 for every dollar of debt that you have to service. So you'd like it to be in that range, especially if you want to account for hardships, as far as prices or yields. But I feel like this is a good scorecard for what we've seen as norms and what might be red flags out there as far as your operations concerned. So, we've talked about a lot of stuff. I just really encourage people, it doesn't matter if you're working with a bank or a farm service agency or farm credit. Just make sure that your lender understands agriculture, understands what your financial abilities are, and know what the trends are, because we are going to enter a period where it's not quite as rosy potentially as what we've seen in the past. Also, make sure they know what programs are available out there. If you need some refinancing, do you need refinancing and an interest rate adjustment? Do they know that you can potentially talk to the farm service agency and get better repayment terms and lower interest rates? It's important. If you're buying farmland, do they know about the beginning farmer program that might help adjust your interest rates that you're paying? And then make sure, if you're not comfortable in putting your balance sheet together, make sure that they can help you with that or are willing to help you with that and put a cash flow together. And then make sure that they will spend the time with you to talk about what those items are telling them. Does your balance sheet seem strong to them? Are there areas that they're concerned about? Is your cash flow adequate? Are there areas they're concerned about? have them actually walk through what they're seeing as they look at those documents. So it's important to know your own strengths and weaknesses, especially if you can do this before you go see the lender. If you don't, when you're working with the lender and they're maybe making these calculations for you, or they're working with putting your cash flow together, have them tell you what they consider your financial strengths and your financial weaknesses. Also, I think when you put together your cash flow, it does help you calculate what your break-even price might be, because doing that cash flow makes you take into account your payments on not only crop inputs, but insurance, property taxes, health insurance, repair. It makes you take all those costs into account, and you can figure out, okay, I have to sell my corn for this much and my beans for this much in order to pay all these expenses that I've outlined. So make sure you do that for nothing else other than calculating your break-even prices. And then understand what your bankers look at. We had a loan pricing system where we looked at ROA, we looked at your debt to asset ratio, and then we also looked at your current position to plug into our grid and give you an idea of what kind of interest rate you're going to pay. So find out what those bankers actually look at. If any of those items get used to determine what kind of interest rates you're going to pay. And if once you find that out, if your ratios are not exactly what they need to be, ask that lender, what can I do to improve on that so I get a better interest rate? They should be able to tell you. So I did talk about the Farm Financial Planning Program. I'm one of several Farm Financial Planning Associates throughout the state, but that service is free. As Ryan said, you should talk to your lender if you're having problems. If you feel like you're not getting enough input from your lender, or you're maybe a little uncomfortable in having that conversation, you can reach out to the Farm Financial Planning Associates. They can look at your operation, do a balance sheet, do a cash flow, kind of work with you on some suggested changes. But they are a source that you can use, and you don't pay anything for it. It's actually provided through budgeting by Iowa State and the state of Iowa. So it's something that you can access as you need it, when you need it. Usually when I have somebody call me, I will meet with them. I try to meet with them in a local extension office. And, once I meet with them, all of their information stays with me unless they want me to talk to their lender or want me to talk to somebody else. Even Iowa State University doesn't know my customers' names. I might use a first name only, just to track hours, but I don't share that information with the university. It stays in my hands and whoever I'm working with hands. So know that it's confidential, know that it's free, and know that we're here to help you answer, questions in terms of how you might better handle your finances. And here's a list. If you go to the website, again, you can access this through Ag Decision Maker, but here's some of the Farm Financial Planning Associates throughout the state. Again, don't hesitate to reach out to them. If you lose this, just basically call your local farm management specialist and ask them who is a Farm Financial Planning Associate in our area, and they can connect you up. So went through a lot. If you have any questions, you can email me. You can call me on my cell phone. I do ask if you call me on my cell to leave a message, because if I don't have no message, I'm going to assume that you're trying to sell me a car warranty, and I will not return that call. So just leave me a message so that I can get back to you on as prompt a basis as I can. And, hopefully I can help you, or at least steer you to some information that will be of assistance. So Lauren, I don't know if you have any questions. A lot of information in a very short time. So
tons of information. My question that I kind of thought of as you were going through your presentation is, what advice would you give someone who was just getting started, doesn't have like family in ag or anything, so they don't have anything for history to show? What can they do to show, or how do they manage or go through that ag loan? Or do you recommend that they wait until they have more history to show before they go that way, that they try to find other ways to finance and get started?
Well, for somebody that's just starting out, I mean, I would always invite them to come and talk to me, but a lot of times, the Farm Service Agency actually gives you the best terms because they've got really low interest rates and really long repayment periods. So they might come and talk to me and I might eventually steer them that direction. But some of their requirements, they used to require 3 years of Schedule Fs before they would actually talk to a borrower. Well, they've changed that a little bit. It might be that you have 1 year Schedule F, and then maybe you've taken courses at Iowa State. You've graduated with an agronomy degree or ag econ or whatever, but maybe you've taken courses that give you skills for managing an agricultural operation. And they count that as like one of the Schedule F years. And then maybe you might not have anything, but maybe you have an aunt, an uncle, or a neighbor or whatever that you've worked with on a farm operation. Maybe you had 4-H projects over multiple years, or you worked with livestock. Some offices will count that as experience as well. So I do like to see some experience. We had a situation back in 2013, 14, where cattle prices just went astronomically high, and people were coming in, they're saying, grandma has 40 acres of pasture. I want to buy cows to, $3,500 cows to put on that pasture. And it's like, so have you ever calved out cows before? No. No, I don't think you want to do that. I would prefer to loan money to someone who actually has experience in raising cattle and working with cattle. So we do like to see some experience. It doesn't necessarily mean that you owned anything. Just if you worked with somebody, so that I feel like you have the ability to take care of your livestock, or you have the ability to take care of that crop ground. Again, if you are just starting out, you probably can't afford to buy machinery. So do you have somebody that you're working with? Maybe a neighbor said, if you help me plant and harvest, I will let you use my machinery on your crop ground. That's great to know. That helps to know that. So try to collect that information. But they do like to usually see some kind of experience or training just to see that you know what you're doing. And again, start with the bank. If it's a banker that knows agriculture, they probably will do like I do. If it's something where they feel like they can't help you as well as a farm service agency can, they should steer you that direction, because again, lowest interest rates, longest repayment terms, which is very helpful when you're just starting out.
Absolutely. I imagine quite a few people within our audience for this series are so me and my husband come from a farm background, but we're removed for several years, and then we purchased our own land ourselves, and it's kind of like to purchase a herd of cattle like right away or something like that. Like, how do you show that you're responsible? Yeah.
Yeah. Well, if your family farm operation had cattle, I'm sure you didn't sit in the house while your mom or dad did all the outside work. You just need to be able to substantiate that. Or if you had 4-H or FFA projects where you handled cattle, again, sure that.
No, and it's always interesting. I made the comment to someone just earlier today, as they're looking at farm ground, a piece of farm ground that's in the family is going up for sale, right? And they made the comment, they're like, what do I do? It's like, well, you need to run an analysis to see what your cash flows are and if you can handle it financially and economically. And it's like, and then you need to go talk to a lender. And it's like, well, what programs are out there? And it's like, well, your lender should know what programs are there. If they don't, you need to find a new lender.
I agree with that, Ryan. That was great advice. And sadly, I've not worked on any transition kinds of plans this year, but the 2 years prior to that, there was a lot of work where one generation was worried about transitioning on the farm to the next generation, especially, where you have on-farm heirs and off-farm heirs. And the toughest thing was that they might set up a program where that on-farm heir was going to be buying land, at market prices. And that maybe not, that might be too tough for them to do. I would encourage anybody that set up a transition plan in the last few years to go back and re-examine that and see if you might be better off saying, you know what, instead of saying all the land's for sale, and this guy maybe gets the right of first refusal. Instead, go back and say, is there a way to divide that land where maybe so many acres can be given to the on-farm heir, and then the rest of the land gets sold at fair market value? Or maybe you give a specific tract to each child so that those that want to hang on to farmland are not paying current prices, because current prices, you just can't cash flow them. You really can't if you have to borrow the money. And so, if you really want that farm to continue, you may need to adjust those transition plans that were put together. And, it might be a tough conversation. They usually are, but I think it's important to have.
Yep.
Also, we've seen a lot of non-traditional. I have to share a story with you. So a couple of years ago, I had somebody that was telling me they were going to start growing lavender. They wanted to sell bunches of lavender, dried lavender, at farmers markets. And they figured out if they sold a small bunch for $8 and a big bunch for $12, they would more than cash flow. And so this person started, they planted 1,500 lavender plants. And they kind of nursed them through the first few weeks, make sure they got started. And then they left on vacation for 2 weeks, and they came back. They had nothing but solid weeds. They eventually worked that out, and the plants survived. They grew them. They dried the lavender. They went to the farmer's market, had these bunches, and the person next to them in the farmer's market stall next to them said, so wait a minute, what are you selling your lavender for? $8 for the small bunch, $12 for the big bunch. The next week when they went to farmer's market, the person next to them had lavender bunches, and a bunch that they were selling for $8, that person was selling for $4. So you need to really think through some of these alternatives. There are budgets out there. I remember looking one time, like Kentucky, University of Kentucky had blueberry budgets, and there's those kinds of things that you can find them on the internet. But if you could find somebody that's actually gone through the process, talk to them so they can tell you, here's the mistakes that I made, in hopes that you don't make them, and then really think through your marketing plans. I think you need to have, for non-traditional crops, you need to have a couple marketing plans so that they feel like, your lender feels like, okay, you do have a handle on this. You realize that there's different alternatives out there, so you can actually get money for this crop that you're growing. This person that was doing the dried lavender bunches, they actually morphed into doing lavender oil, lavender candles, and they've been very successful because they've done that, but they had some definite growing pains.
So there's a great resource called the Ag Marketing Resource Center that has a lot of different budgets. So it's a place that tries to pull those all into one place, for all those budgets of mint, vegetables, nuts, fruits, forestry fiber, biomass, and they try to pull all that into one thing on the specialty crops. So that's a great resource if you're looking at niche markets, I would say.
Good to know.
Oh, definitely include that. Yeah. All right. Those are the questions that I thought of. Is there anything else you guys want to add as closing thoughts?
Just know that it might be a little harder winter than it has been in the past years. And Ryan and his peers and myself and my peers, we're here to help you if you need that extra help. It's important to talk with your lenders if you have some concerns, and talk with them early rather than later.
Especially as we get into this next year when things might get a little bit tighter and finances and cash flows are a little bit tighter as well. So.
Excellent. Well, thank you so much for your time, Leslie and Ryan. I really appreciate it.
You're welcome.
I hope you guys have a great rest of your day.